Hey everyone, Raul Shah, Doc Shah Financial. I create and manage stock portfolios for clients. So today is a really fun topic. It is Roth conversions. And we're going to talk about when to do it, when it makes sense, and how to do it as well, and then some important rules to keep in mind. So the bottom line on when to do a Roth conversion is if your income today is expected to be lower than your income in the future. Now, why is that? Well, what are you doing when you're doing a Roth conversion? You're ultimately taking pre-tax money in a traditional IRA and you're lifting it out of that bucket and putting it into a Roth IRA bucket. So a Roth IRA is taxed differently. You're taxed when you put money into that bucket. So anytime you're taking money out of this bucket and into this bucket, you're going to pay a tax on that money. So a Roth conversion involves taking money from this pre-tax account, paying a tax, and then putting it in your Roth account. And we'll get into why you would want to do that in a few minutes. But the advantage up front is that you're going to pay a lower tax rate because your income is lower today. And that money will then grow tax-free. And then ultimately, when you take it out, it'll be tax-free withdrawal. So you would want to do a Roth conversion in general when your income is lower than it's going to be in the future because you're in a lower tax bracket. So what are some examples of when that might be the reality? Well, let's say you're early off in your career. So you're not really making that much right now, but you're going to make a lot of money one day. So you might want to do Roth conversions early on in your career so that you are managing your overall tax burden. This easily can save you thousands in taxes up front, but when you invest those thousands, you could make $100,000, $200,000 over the lifetime, 10, 20, 30 years of consistently investing. That's the opportunity cost of not doing these Roth conversions. What's another example? Let's say you retire early. So it's before you started taking your Social Security, it's before your RMDs have kicked in. You're in a lower tax bracket. You could strategically do a Roth conversion and take advantage of that so that ultimately when you are older and you have more income coming in from these different sources, you are not going to be exposed to as much higher of a tax burden. What are some other examples? Well, let's say you start a business. So you have a lot of operating costs starting this business. So your income in a particular year might be lower. Okay, that's a great time to do a Roth conversion. Another example could be maybe one year you make a really huge donation. So your taxable income is going to be lower. So again, maybe it's a good time to do a Roth conversion. You get the idea. Basically, when you're in a lower tax bracket today, it makes sense to pay that tax to avoid that higher tax that you would ultimately pay in the future if you didn't do that Roth conversion. So first of all, you can convert all or part of the money in your traditional IRA to your Roth IRA. The key here is that you don't want to keep pushing yourself into higher tax brackets. What we want to do is called filling the bracket. And that's basically taking advantage of, you're in a particular tax bracket. Let's say I'm in the 12% tax bracket. I want to fill that bracket up until the point where I would get pushed into the next one. And I don't want to exceed that because then I'm going to actually pay more tax. So that's why when you work with somebody, it's a lot easier to understand, hey, these are your brackets. This is how much we need to fill up and how much we need to convert and sell. And there's a lot of things going on, but you want to keep that in mind. The second thing you want to keep in mind is even if your income exceeds what if you would be even allowed to put money into a Roth IRA, it's not relevant. You can still do the conversion. So even if you're making a lot of money, we can still do a conversion. You also want to be aware that withdrawing converted funds before 5 years will trigger a 10% penalty. So that's very important. We don't want to pay penalties on any money that we've earned. And also understand that RMDs cannot be converted into a Roth. So if you're at that point where you're already taking those distributions, you're not going to be able to convert that and put that into a Roth IRA. But hopefully this gives you an idea of why you would do it and then just some things to keep in mind. And now let's talk about actually how you would go ahead and do that. And the first way is just through a rollover. So you could take a distribution from your traditional IRA in the form of a check and then deposit that money into your Roth IRA. You need to do this within 60 days so you don't pay a 10% penalty. Again, we don't want penalties, not a good idea. You could do a trustee to trustee transfer where you just instruct your brokerage house to take your traditional IRA and convert it to a Roth IRA at another brokerage house. Or you do a same trustee transfer, which is you just instruct your brokerage house to take the money that's in your traditional IRA and convert it to your Roth IRA. These are all pretty straightforward processes, but we have to keep in mind there are nuances to this. If you want help with Roth conversions, creating and managing a stock portfolio, and comprehensive wealth management solutions, go ahead and shoot me an email, raul@docshoffinancial.com. I always respond, and I look forward to hearing from you. Thanks so much for watching, guys, and I'll see you in the next one.